Welcome back to the Deep Dive. Today we're looking at Potbelly Corporation's Q2 2025 earnings call. But there's a twist.
A big twist.
Yeah, because not long after this call, RaceTrac announced they were buying Potbelly for, what was it, $17.12 a share? A massive premium.
Exactly. So our job today is kind of like forensic accounting, right? We're looking at this specific earnings call.
Right. What exactly did Potbelly show in Q2 that made someone say, okay, yeah, this is worth nearly $570 million?
That's the mission.
Yeah.
Because this wasn't just, a decent quarter. This was the proof point. The moment the turnaround story felt real tangible.
Showing they could actually become this high-growth, franchise-focused brand.
The Q2 results essentially became the validation document for that big price tag.
Okay, let's start digging through the evidence then. Headline numbers first. Management definitely beat expectations, top and bottom line. What were the key figures?
Well, the adjusted EPS came in at 9 cents. That was just a penny ahead of the consensus, around 8 cents. So solid beat there. Revenue was $123.7 million. Also a beat, but maybe a bit more modest, up 3.4% year over year.
So not a blowout on revenue.
No, but the quality of the earnings, that's where it gets interesting. Adjusted EBITDA hit $9.6 million.
And that was up
13% compared to last year. And importantly, it landed right at the high end of the guidance range they had previously given. That shows strong execution.
Okay, EBITDA growth is one thing. But for restaurants, especially fast casual, everyone zooms in on same-store sales, right? How did the existing shops perform?
Yeah, SSS is critical. Company-operated same-store sales were up 3.2%.
3.2%. And the key part here you mentioned was traffic. It wasn't just price increases driving that.
Exactly. That's a really important distinction, especially, with everything going on in the economy. Positive traffic is a much healthier sign.
And system-wide sales, because that includes the franchises too.
System-wide sales grew 6.7%, and average weekly sales, or AWS, climbed to just over $27,000 per shop, up about 3.6%. It all points to good momentum in the stores.
But hang on, let's push on that traffic number. 1.1% positive traffic. I mean, is that really enough to get excited about? Enough to justify the stock pop and the eventual buyout? Seems kind of small.
It's a fair question. You got to look at the context. So that 3.2% SSS breaks down into 1.1% from more transactions, that's the traffic, and 2.1% from people spending more each visit, the average check.
Okay.
But management made a point of saying they hit this number despite the Easter shift. Easter moving between quarters can sometimes mess with the numbers.
Right. It creates a headwind sometimes.
Exactly. And maybe even more importantly, they said sales momentum actually accelerated through the quarter. April, then May, then June got stronger.
Ah, okay. So it wasn't just a blip, it was building.
Right. It suggested the demand was real and growing because of what they were doing strategically, not just like random price hikes catching up.
Okay, that makes more sense. And if volume is accelerating, you'd expect to see that help margins, which we did. Shop level margins went up 100 basis points, a full percentage point.
Yep, landed at 16.7%. Pretty healthy.
So how much of that was just getting lucky with food costs versus actual management skill, controlling expenses?
It was a mix, but tilted towards skill, I'd say. They definitely benefited from food costs being a bit lower. FBP, that's food, beverage, and packaging costs, improved by 80 basis points to 26.3% of sales. So yeah, lower inflation helped.
Bit of a tailwind then.
For sure. But management really hammered home the prudent cost controls and keeping a lid on G&A expenses. They weren't just letting costs run wild.
And they're locking in prices too.
Yeah, they mentioned being about 85% locked in on their food basket for the whole year. They see inflation staying pretty manageable, like under 2% in Q3, maybe just over 2% in Q4. So some luck, yes, but mostly discipline management making that margin improvement stick.
Okay, so discipline costs help the bottom line. Let's talk about driving the top line. The menu and value strategy. They seem serious about upgrading what they offer.
Absolutely. The big news was making the prime rib steak sandwich permanent back in April. That followed the pulled pork launch.
So moving beyond just limited time offers for the premium stuff.
Exactly. It signals they're confident in the quality and demand for these higher end items. And they didn't stop there. New Potbelly branded hot pepper chips partnered with Zapp's, which is kind of cool.
Oh, yeah.
And upgraded salad dressings from Marzetti. Little things, maybe, but they add up to a better overall product perception.
But how does that fit with value? Premium steak and fancy chips doesn't usually scream value meal.
Right. It's a balancing act.
Yeah.
They talk about a three-part value approach. First is that intrinsic value, better ingredients making the regular price feel worth it.
Okay.
Second, they have everyday value. Stuff like the $7.99 skinny combos or meal deals. That catches the more price-conscious customer.
Gotcha.
And third, the promotional value. This is key. They mostly push promotions through their digital channels.
So targeting offers to loyal users, not just blanket discounts.
Precisely. It drives profitable traffic from engaged customers using data, rather than just slashing prices across the board and hurting margins. It's smart.
That brings us nicely to digital. Huge part of the story. Over 41% of sales now coming through digital channels.
Yeah, up about 140 basis points from the year before. It's a massive number.
And what was the big news on the digital front in Q2? Wasn't just penetration growth, was it?
No, the really big deal was the launch of the completely rebuilt website and mobile app right at the end of June.
Rebuilt from the ground up.
Totally rebuilt. Based on customer feedback, they'll talk about features like one-click reordering, much easier navigation, better personalization, making it genuinely easier and better to use.
And for a potential buyer, seeing 41% digital, that's huge, right? It means a direct connection to a big chunk of your customers.
Absolutely massive. It means you have this loyal, trackable customer base. You have rich data on what they buy, when they buy it. You can target promotions incredibly effectively. It screams long-term, high-margin, sticky growth.
Okay, so digital is driving sales in existing stores. But the real validation for a growth story, especially one aiming for a big valuation, is new unit expansion, franchising. How did Q2 look there?
This is where the story just lit up. It was a record quarter for franchise commitments. They signed deals for 54 new shops.
54 in one quarter.
54. That pushed their total pipeline, so open shops plus committed future shops, up to 816.
Wow.
Which, as they pointed out, is over 40% of their long-term goal of getting to 2,000 plus units eventually.
And were they actually opening stores too, or just signing deals?
They were opening them faster than expected too. They opened 8 new shops in Q2 when the expectation was more like 6. So the pipeline wasn't just paper promises, it was turning into actual stores.
And they have that interesting incentive structure, the 50-50 incentive, to speed things up. Explain that again.
Yeah, it's pretty clever. So normally a franchise signs a deal and has, say, 8 years to build out all the stores they committed to.
Right, a long timeline.
The 50-50 incentive basically gives the franchise a discount on their royalty payments if they open those stores ahead of that 8-year schedule.
Okay. So Potbelly gets stores open faster, franchisees save money, win-win.
Exactly. It aligns incentives perfectly. Potbelly hits its growth target sooner, which investors love, and the franchisee improves their return by opening faster. It makes that big pipeline number feel much more real and achievable, much less risky. That mechanism was probably a huge factor in why the market and eventually RaceTrac started believing the growth story.
So putting it all together, solid traffic, better margins, huge digital gains, and this franchise engine really starting to roar. It makes sense. Management felt confident enough to raise their outlook for the rest of the year.
Definitely a strong signal of confidence. They bumped up the full year SSS guidance. It was 1.5% to 2.5%. They raised it to 2.0% to 3.0%.
Okay.
And adjusted EBITDA guidance also got a lift from $34 million up to $35 million.
Did they keep the unit growth target the same?
Yeah, they held firm on opening at least 38 new shops for the full year, which, given the Q2 beat, probably felt pretty achievable. And their Q3 outlook was strong too, guiding to SSS growth between 3.25% and 4.25%. Just continued momentum.
Right. So with the business performing well and debt mostly paid down, where were they putting their money? What were the investment priorities?
Very focused spending. High return stuff. First, building new company-owned stores, maybe up to 20 a year. Focusing on areas where they already have a presence, densification, and keeping build-out costs tight.
Makes sense. What else?
Second, they're testing out story models. They have different tiers, skinny, original, big, basically testing how much they need to spend on a refresh to get the best sales lift and return on investment. Early results sounded positive.
Trying to find that sweet spot between cost and impact.
Exactly. And the third piece, often overlooked but critical, is technology inside the shops.
Right, the PDCX, KDS, POS, all those acronyms. What does that actually mean for the store?
It means efficiency. PDCX is their new in-shop operating system. KDS is the kitchen display system, those screens replacing paper order tickets in the kitchen. Speeds things up, improves accuracy. POS is the point-of-sale system where you pay.
And handhelds for staff, too.
Yeah, handheld ordering devices. It's all designed to make the shops run smoother, handle more orders faster, probably save on labor eventually, and just cope with the higher volume they expect from digital and franchise growth. That full rollout is planned by end of 2026.
So investing in the foundation. And they were still buying back shares, too.
Yep. continued the buyback program, picked up about $1 million worth of stock in Q2. Small amount, but shows continued confidence.
Okay, let's pull back for a second. You mentioned context earlier. This strong performance from Potbelly, it was happening while the broader restaurant sector, like the EATZ ETF, was actually kind of lagging, right?
Yeah, that's super important context. The restaurant sector generally was facing headwinds, inflation concerns, cautious consumers, intense competition. It wasn't an easy environment.
So Potbelly was really an outlier?
Definitely. It was an idiosyncratic story. They had this unique combination: positive traffic driven by their own initiatives, the franchise growth kicking into high gear, the digital success, and they raised guidance. That package was a clear company-specific positive signal that stood out against the gloomy sector backdrop.
And that's why the stock reacted so strongly initially, because investors saw it breaking away from the pack.
I think so, yeah. The market recognized that the turnaround wasn't just talk anymore. The execution was there. And that realization, that validation by the public market, likely paved the way for RaceTrac to step in with the acquisition offer. It proved the value was real.
The ultimate proof point, really. Getting acquired at that premium confirms the strategy worked and the growth potential was undeniable.
Absolutely. It showed maybe the public market hadn't fully appreciated just how much structural change had happened under the hood until that Q2 print really spelled it out.
All right, that brings us to our final segment. This is not financial advice, where we toss around a maybe slightly outrageous but plausible trade idea based on everything we've just discussed.
Okay, let's brainstorm. We've got this situation. Potbelly gets bought out at a premium, validating the franchise-led, digital-heavy turnaround model. Meanwhile, the overall restaurant sector, EATZ, is still facing challenges.
Right, so you have a specific success story contrasting with general sector weakness.
So the pair trade idea emerges from that divergence. What if you were to, theoretically, short the broad restaurant ETS, EATZ? You're essentially betting that the macro headwinds continue to weigh on the average restaurant company in the near term.
Okay, short the sector.
And simultaneously, you go long a different publicly traded quick service restaurant. But not just any QSR.
One that looks like Potbelly did maybe 6 months or a year ago?
Exactly. You hunt for a company that's showing those early signs of a Potbelly-style transformation, accelerating franchise commitments, maybe a recent app relaunch or a big digital push, signs of margin improvement through cost control.
Betting that the Potbelly deal shines a light on similar turnaround stories that the market hasn't fully priced in yet.
Precisely. You're betting the Potbelly acquisition creates a sort of valuation floor or even pulls forward M&A interest for the next company that successfully executes that playbook. It's playing idiosyncratic strength against broader sector weakness.
Interesting angle, exploiting that contrast. But again, strictly an idea for discussion.
Absolutely. Not financial advice in any way. A necessary disclaimer.
So wrapping up the Potbelly Q2 story, it was a clean beat, driven by real traffic growth. Margins expanded thanks to cost discipline, not just luck. Franchise growth hit record levels, helped by that clever 50-50 incentive. And digital hit over 41%, validated by a major tech upgrade, all leading to raised guidance.
And the key takeaway for you, listening, is really the power of that company-specific execution. When a management team really nails its strategic pivots, like going hard into franchising and digital like Potbelly did, it can totally disconnect from the general sector trend and command a premium valuation. It caught the eye of a buyer in a big way.
Which leads to our final thought. Potbelly got bought at a big premium. But how much of that value, that 41% digital penetration, that franchise pipeline, was really understood and priced by the market before this Q2 call? And maybe more importantly for you looking forward, which other smaller, maybe overlooked restaurant brands are executing a similar playbook right now, but are still being valued based on sector gloom instead of their own potential? Something to chew on.
A great place to leave it. Thanks for joining us for this deep dive.
We'll catch you next time.